and they'll tell the story of I sold in 2008 and I never reinvested it. Oof. Right?
Hello and welcome back to Real Personal Finance. Welcome, Scott.
Hello.
Well, in the last episode, we geeked out a bit about how to create an investment portfolio. At least we started that conversation.
Yeah.
And it's really hard not to go down the 3 million rabbit holes that are in the investment world. So we talked a lot about sort of the biases, the just a few biases that we see most influencing sort of human behavior or clients' behavior towards their investment portfolios.
Yeah.
And today we wanted to talk about how to actually construct a portfolio that is right for you.
And so when we think about constructing a portfolio, I think we first have to start with what are the main ingredients that you see in a portfolio. And there's really, if you think about what can you invest in around the world, there's really 3 things you can invest in around the world. There's technically 4, but we'll say there's 3. So there's stocks, or also known as equities, and that's like owning a company. There's bonds or fixed income, and that's really lending money to someone else. And
lending to a company.
Yeah, lending to a company, someone else. And then there's cash. Those are really the 3 things that we can hold in a portfolio.
And just as a slight tangent to say, like, yes, I know there's real estate. Yes, I know there's crypto. Yes, there are commodities, and we are intentionally not talking about those
alternatives
today.
into the portfolio today. Yeah. And the reason we're not going to bring in gold or crypto or specifically real estate, which actually, if you want real estate specifically, a real estate investment trust makes up about 3% of the global stock market. So yes, you could have a real estate investment trust, but if you just go ahead and own the underlying markets, you will inherently be owning those real estate investment trusts anyway. So that's why we're not really bringing in that geekiness, but thank you for bringing that up.
Yeah.
But so those are the 3 big things you can own. So stocks, bonds, cash. Now let's just talk briefly about how to think about risk for those 3 things. Okay.
Sure.
So if I own shares of Apple stock, like I bought shares of Apple, I now am an owner of Apple. So if Apple does well and people want to pay more to own Apple, the stock price will go up. If Apple results if the earnings results of the future are dire, you're going to see stock price go down. So I'm going to ride up and down with the stock price. And then the other thing that can happen with stocks is some of those companies will choose to give back to their owners in the form of what's called a dividend. So they will literally give you cash. They'll pay you a cash dividend so that you can receive some of the profits of the company. We can talk about on a different time whether or not that's a good or bad thing. If they're giving a dividend, it usually means they don't have enough projects to reinvest in that they believe will give them a higher rate of return. So they're choosing to give money back to their owners instead. And then one little side note about dividends, because some people will think like, hey, I'm going to retire, so I'm just going to get a stock portfolio of dividends because dividends are good for me. I just want to give you a little example that if you own a $10 stock and it's going to pay a $1 dividend and the stock price doesn't go up or down, the moment that dividend pays, the stock is no longer worth $10. It is immediately worth $9. Because you owned something that was worth 10 and they paid you 1. So you now own a $9 stock. So just keep in mind that like dividends can be nice, but they aren't the end all be all. And I'm digressing really, really fast because I can do that when I talk about stocks.
All right. Back to the top level. Yes.
Yeah. Top level stocks. So stocks are risky. And they're the riskiest because you are the owner of the company, right? So think about instead if you are lending money to a company or a government. So if I go to Meg's company and I say, Meg, I want to invest in your company Flow, I want to expect a pretty high rate of return on that return for me to get my money back. So I need to see a good business plan and good strategies so that we can see that. And what are the cash flows been in the past? And what do we think is going to happen in the future? And it really is all about what's going to happen in the future for what do I think that rate of return is going to be. When we then go to look, if instead Meg comes to me and says, hey, can I borrow 50 grand from you instead of you investing 50 grand in my company? Well, I'm not going to expect the same rate of return because I'm going to expect that in 3 years, Meg's going to give me my $50,000 back. Right. So if I'm going to lend you 50,000 and you're going to give me 50,000 back, I don't need the same rate of return as I would expect if I'm going to be a stock investor. Right. It's not as risky because you're going to give me my money back. So we're inherently going to see the rates of return on bonds be lower than they're going to be on stocks, typically, is what we see. And that's what we see in markets.
Right. Because the risk is lower.
Right. And then when we look at cash, when we say cash, that you could invest in cash, what we're really talking about is investing in very short-term U.S. money, U.S. treasuries. So it's basically lending money to the United States government for 90 days or less. And then you can also do that to corporations through things called money market accounts. And those we're typically going to see even a bit less of a return as compared to bonds.
Yeah. And when I talk with my clients, and maybe this is just idiosyncratic to me, I don't even consider cash an investment. Like, it's a tool, it's a financial tool, but I like to think about it. Investments are something that you expect an actual return from, and you're just not getting much of a return.
Yeah. And to be clear, I don't expect that. We don't invest in them in portfolios virtually at all either. We might carry like 0.5% of cash in portfolios for rebalancing needs, but we don't typically invest them. The reason I bring them up is because it is a choice that you can make of where do I want to hold a position.
Exactly.
And there's certain instances that we'll talk about where owning a cash position might make a lot of sense.
Absolutely.
So that's stocks, bonds, and cash. Then we think about stocks overall. Stocks are a huge, huge thing. There's over $81 trillion of stock available in the world, which is just like, I don't even think I can wrap my head around that number. But there's the U.S. is the biggest market. It's about 61% of the world market. And there's about 3,500 stocks available in the United States to trade. Right. And then you think about developed markets. That's like the UK and Australia and Europe and Japan. That's 6,500 companies, about $21 trillion and about 27% of the world. And then you can invest in emerging markets. So emerging markets are like China, Brazil, India, and that's 24 countries, about 10,000 stocks, and about $10 trillion, about 12% of the world. So there's all these potential areas to go and invest in. And oh my gosh, it's like, how do I choose where to go and what to do?
Yeah. And as complicated and daunting as that might sound for stocks, the bond markets are like an order of magnitude more confusing.
Yeah.
So we're not even going to attempt to go very deep with that. But I did want to call out that you had previously mentioned, getting a treasury bond, a U.S. treasury bond.
Yeah.
Right. And that's the kind of bond that gives you the safety that we look to bonds to provide. And I just want to contrast that to lots of things are called bonds and function as bonds. Like, they're loans that you expect to be paid back and also get paid interest along the way. But you can invest in what are now called high yield bonds, used to be called junk bonds.
Yep.
And they, in fact, perform way more closely to the way stocks do. They have the same sort of risk characteristics as stock than they do to U.S. Treasury bonds. So when we're talking about bonds, if you want bonds to play a role of low risk, sort of more of a guarantee you're going to get your money back, then you're really looking for safe bonds, treasury bonds, or if they're bonds with companies like AAA, like a very highly rated, stable companies, not high yield bonds.
Yeah. So you're making two really good points there on the bond market. So the bond market has so many different areas that you can go invest in, to Meg's point. So you can invest in government bonds all around the globe. Now, if you start doing that, you'd start dealing with another thing called currency risk. So you have to look at whether currency risk is taken out by basically arbitraging away the currency swap that can happen. So that's getting super too geeky too fast. But the simplest answer is just in the US alone, you can invest in US government bonds. You can invest in municipal bonds, basically all around any state or any local municipality. And doing so has some benefits, like in the state of California, where I am. If you invest in municipal bonds, you don't have to pay federal taxes or state income taxes on those bonds. And then you can also invest in governments, corporations, to Meg's point. Anytime you invest in any of these other than the United States, you want to look at two things. You want to look at their credit rating, and you want to look at the term that you're going to hold the bond for. So credit rating is literally like the credit score that you have, I have, and Meg has. And depending on your credit score, if you go get a mortgage today, the lower your credit score, the higher your interest rate's going to be. And the same thing happens in the bond market. The lower their score or rating is, so once they're double B or lower, so it goes triple A, double A, triple B, double B, B, all the way down to C, and then lower in default. The lower they are, the higher their interest rate needs to be. And so to Meg's point, when you go into these high yield bonds or these junk bonds, you're getting really high rates of returns. You're getting high yields, but the chances of them defaulting are also higher. So it actually takes away from the benefit of owning a bond. And so maybe for a moment, we just chat about that benefit. The benefit of owning a bond to us in a portfolio of stocks and bonds is to create a ballast in your portfolio. So I actually think of it like, here in San Diego, we have a big fleet of ships, including aircraft carriers. And when they go out to sea, they have these things called ballast tanks inside their hulls. They can literally draw water into their hull to sink them down into the water so that they travel a smoother way through the waves. Right. And that's really when you think about what bonds do in a portfolio, or what they're intended to do, I should say, because they don't always behave this way.
Yes.
What they're intended to do is that when stock markets go down, bonds stay fairly safe. They don't move too much. Now, we didn't see that in last year in 2022. It was one of the first years since the 70s that they really, really moved together because interest rates were so low and spiked so much. But that is the point that we're trying to get at, is we want them to smooth it out. And the way you smooth it out is by going high credit, shorter maturity. You do those two things, you're usually in a better place. So that's where Meg's coming up with those points.
So the combination of stocks, which are volatile. I mean, you just look at any individual company's stock, and they're, look at a price chart over history, and goes up and down, waggles a lot. That's where you get the returns, but you also get that volatility.
100%. Right? And we can see that. And you're making such a good point, Meg, because even if we just think about like the S&P 500, right? Because people are always familiar with the S&P 500. And especially right now, it's like just keeps going up and up and up and up and up. And it's been doing great for quite a while. Well, the best 1 year return of the S&P 500 was 65% in 2020, coming out of COVID. And the worst 1 year return was minus 48% in 2008.
Yeah.
So
recent history, both of those.
Yeah. And so like if you're invested in them over that period of time, you're like, well, this is great. I can so long you might be thinking like, okay, I have this goal and I'm going to invest in a year, I'm going to need this money. Well, if you and I are looking at that, we're going to go like, hey, don't invest just in the S&P 500, because you could see a drawdown as bad as 48%.
Almost 50%.
Yeah. That'd be horrific. Yep. Be careful.
Yeah. Which gets to the biggest driver of investment returns, which is sort of the single most important decision you need to make in constructing your investment portfolio, is what is that balance of stocks and bonds that you should have in your investment portfolio? And that is technically called an asset allocation. But it's very simply just the balance of stocks and bonds. That, more than anything else, more than like the individual stocks or stock funds or bonds or bond funds, more than anything else, that is going to determine your long-term investment returns. So let's get it right. And there's not one single answer, but there's sort of ballpark right answers there. So how do you determine that best balance? I've got $1 million I want to invest. How do I determine how much of it to put in stocks and how much of it to put in bonds?
Yeah, so that you and I are on the same page here, and here's the key for the list for you all at home is that what it really comes down to is it's not about just how much return am I going to get, it's about how much risk am I willing to take. So what are the risk and return characteristics I'm willing to take on? And then the methodology to think through is, well, how much time do I have to invest until I need this money? Are taxes a concern that I need to think about for this? Are there any unique circumstances that are warranted here that I need to take into account for? So you start to take into account these various components, and then you figure out, what should I do? How should I build this? So maybe a good example, Meg, would just be, because it's someone that you and I run into all the time, where people will be like, how should I invest my money I'm saving for a down payment on a home, and I'm going to get my home in the next 2 years. What should I do? And they'll want to know, like, should I invest in the stock market?
Yeah. And big old no for me on that one.
Yeah. And it's not about 7 out of 10 years, the market's up, right? That's great. The problem is that 30% of the time it's down. And so the question is, how will you feel if we invest 100% of your $200,000 down payment in the market and it falls by 40%, right? So you lose $80,000 and now you have to work your way out and delay getting the home. Versus we just go put that $200,000 in a short-term U.S. money market and you earn 5%.
Yeah. Or, just a high yield savings account. At this point, like, as long as it's not in the bank earning 0.25%, I'm not going to quibble over whether it's in, a 2-year CD or a money market high yield account or money market fund. Something like that.
Fully agree with you, with the little caveat that you're in Washington. So my little pro tip for you listeners in higher tax states is, if you have at Charles Schwab or at Vanguard or wherever you keep your brokerage money, you can usually buy a U.S. money market fund. And because it's only invested in money markets in the US, you will not pay state income tax on that interest. So you're just increasing the yield that you get to keep just a little bit. I'm talking hundreds of dollars here. I'm not more than probably talking thousands, but it's just a little helpful. Yeah,
for sure.
But yeah, fully agree with that. Now, what if so the other side that's easier to think about, so long as they have the stomach for it, is, let's say they're going to retire in 30 years.
Sure. Yeah, really long time frames are sort of the easiest thing to invest for, because the more years you have before you need to take the money out, the sort of safer, I'll use that word advisedly, the safer it is to put your money in the stock market. Because if you look at stock market returns, sort of rolling returns, in any 1 year, absolutely, it can go down 50%. But if you look at, say, rolling 5-year returns, there are fewer 5-year periods out there where the total return is negative. And I think by the time you get to 20-year rolling returns, there has not been a 20-year rolling return with a negative stock market. And certainly once you get to 30, even better.
Yeah. So looking at the S&P 500 from 1999 to 2024, the 20-year return is 8.2%, which people are probably hearing that and going, what? Yeah, there's this thing called the lost decade from 2000 to 2009, where the S&P 500 did not gain because it had such an amazing run in the 90s. But to your point, I'm looking at the worst return data, the 1-year drawdown. I think I said 48 before. My apologies. It's 43. I think I was looking at a different thing. 43% was the worst drawdown for 1 year for the S&P in 2008. 3 years, negative 16, 6 years, negative 6.6, 10 years, negative 3.4. And then once you get to 15 years, you're in positive territory. So to your point, the longer we hold this and we don't panic and we don't move and we keep holding, the better off we are.
Right. So in general, this is not specific advice, but in general, if you don't need this money for 20 plus years, the numbers show that you can stick almost all of it in the stock market, and that is going to maximize the chances you have of reaching your retirement goal.
Yep.
Or whatever that long-term goal is.
Yep. The middle is where it gets a bit more technical, right? And that's where there's really two things that I think about here. One is I have a short-term time frame, let's say 7 years, that I want to have money saved for maybe a second home in 7 years or something along those lines. That's where you either on your own or with the help of an advisor need to come up with a solution that weighs the risk for return with the risk for drawdown together and come up with a plan that works best for you. Right. Because my heart of hearts says, like, don't just keep it in T-bills personally for 7 years. I'm like, I want to put some of that to work, but do I want to put all of it to work? I don't know.
Yeah. That data you were just looking at, Scott, does it have sort of maximum 7-year loss, 7-year rolling period loss?
I don't have 7. I have 1, 3, 5, 10.
Okay. What's 5?
5 was for just the S&P was down 6.6%. Now that's an annualized number, right?
Sure.
So you're still down pretty well there. And then 10 was 3.4. So we could probably say you're in the middle around 5, somewhere like that.
Right. Yeah. So if you absolutely need to have that money then and this amount of money, and your goal can brook no variation from that plan, then that really is going to push you into more guaranteed products like treasury bonds, treasury bills. And you are, the upside of that is you are getting that guarantee of no loss if you hold them to maturity. The downside is you're not giving your money a chance to grow. And sometimes the growth you can get in the stock market, as your numbers were showing, is like phenomenal just within 1 year, right? So you can, choose between how much you want to protect the goal, guarantee the money, versus how much are you willing to risk. And one other component I would also stick in there is if your goal is flexible, right? Let's say you invest for 7 years, you put some of the money in the stock market has a really crappy 7 years. Is it okay with you to delay that goal maybe another 1, 2, or 3 years to let the stock market recover? Right. Because the more flexible that goal is in terms of either timeline or the money you need for it, then the more money you can, quote unquote, afford to put in the stock market. Maybe you'll get lucky and statistics are on your side and your money goes up. But if you do lose money, that's okay, because you had this built-in sort of flexibility or sort of like escape routes or escape valves or something for that plan.
Completely agree. And so much of financial planning that we do with clients is all about resiliency and flexibility in planning, right? So to your point, that's such a good point to make. The other one that I think about, because I think a lot of retirees will hear this and be like, oh man, if I'm going to retire in 20 years, I should be 100% in the stock market. And if I need money today, I should be 100% in T-bills. There's a happy medium here, because when you have to remember that when you retire, you're not just retiring for 1 year, you're usually retiring for 30 to 40 years. So you need a portion of your portfolio to be growing for the future, to outpace inflation, so that you can actually afford to live in the future, right? Yeah. And because of that, you have to take that risk more than likely. Most people have to take that risk. Most people don't have portfolios to the size where they can just put it in a T-bill and collect their 5% for the rest of their life and be totally fine. Like they need to have that growth happen to be okay. You need to couple that with bonds inside the portfolio too. And the bonds, yes, they are a ballast for to make it a safer, smoother ride. And they're really functioning also as like a little bit of you can think of it almost as like a war chest for you. So just think of it as like when the stock market's doing well, we talked about it in the last episode, that when something's doing really well, we're going to sell it because it's doing well. We're going to sell high, right? But the other thing that we need when we're retiring is we need to make it so that when the portfolio goes down in value, well, now we don't want to sell from that. So what are we going to sell from to give ourselves income? We're going to sell from the bonds in that period of time to go ahead and allow the market to come back. So you need both things in a portfolio when you're retired, because you're really, your time horizon is multifaceted when you've retired. You have the need for cash flow today, but you also have the need to generate wealth for the next 30, possibly 40 years.
Yeah. And for people in what we very inhumanely called accumulation, which is to say you're still working, you're still saving towards that eventual goal of retiring and living off of your investment portfolio. You know, hey, I want to retire in 30 years. Should I just have all of that money 100% in stocks? And one reason the answer is no is this element of psychology. How easy is it for you to see your 401k lose half of its value, right? Which, if it's 100% in stocks, you would have seen it lose half its value in, between 2007 and 2009. Because the worst thing you can do is actually change your asset allocation either in up times or down times, bad times, right? So the proper asset allocation is actually the one that you can stick with.
100%. And the other thing that I think I would end with for asset allocation as well, because we're kind of giving these really simple choices, right?
Mm-hmm.
But then there's well, what if I want to change my career, right?
Mm-hmm.
Well, you have to look at your balance sheet from a standpoint of what is its purpose? What is it serving? What are its main goals?
Mm-hmm.
And if it goes from a goal of I'm going to stay at my current company for the rest of my life to I want to go I'm going to go start my own company. Well, then all your assets might need to help support your life now. So that drastically changes the way they should be managed and held. So just recognize that it's flexible and fluid and you're allowed to change it. You don't have to set it once and then never change it. You set it based on the goals you have in your life. And then you reassess the goals and see, do I need to make changes? And to your point that you made there, some of the biggest wealth that I've ever seen not created is people it's funny and it's also sad. It's people coming in to get help later in life, and they'll tell the story of I sold in 2008 and I never reinvested it. Right?
Oof.
If you've made those choices, that's a behavioral choice. One of the best things you can do for yourself, in my opinion, is find a really good financial advisor, because what they do is, if they have a good philosophy, like I know both you and I have, and they stick to it, they're not going to allow the emotion to make a choice, right? And that's going to lead to a better outcome. So you're far better off looking that way if that's you, if you're not going to stick with your own plan.
Yeah, and I was just thinking, there is such a direct analogy between, outside of investing, our approach to personal finances. Look, we figure out who you are, what your values are, what your goals are, what kind of life you want to live. And then we make financial decisions to support that.
100%.
And inside your investment portfolio, it's the same damn thing. You start with why. What goals is this money going to support? Right? So it's driven not by what do I think the market's going to do. It's driven by what goals am I trying to support. And you structure your initial investment choices, and then any future changes. You don't make changes because the market is up or down. You make changes if and when your goals change. So always coming back to, have my goals changed? Has the time frame to my goals changed? And if those two things have changed, then that merits considering changing how you're investing your money. What does not merit considering how you're investing your money is if the market's up or the market's down.
Or what someone says on a headline or at a barbecue or anything else. This is really about running your own race. And then it's about, at least from our point of view, it's about running your own race with practical investment philosophies that are tried and true and tested, and don't mess with them.
Right. And I would say, I think it's important to write it down. Write down, what are your goals? How much money do you need for it? What are the time frames? And then what's that asset allocation, balance of stocks and bonds? And then those are the rules you return to. When you feel tempted to tweak your portfolio, you return to that. No, these are the rules. I made these rules after due consideration of who I am and what I value. You're always returning to those rules. to, lash you to the mast like Odysseus.
Absolutely.
Okay. Thanks, Scott.
See you guys next time.